I look at things, I have a model called the inflation, deflation, and economic cycle model. It looks at the second derivative of inflation in the context of economic growth. And in that way, it allows me to participate in bubbles when they're blowing up, and then gets me and my clients out of harm's way when they unravel. And we're close to having another one of those episodes. You know, the average recession, I think it's down 37% on the S&P 500. That's the average recession. And if you look at 2000 recession, NASDAQ bubble collapse, if you look at the 2008 global financial crisis, the S&P dropped 50%. And the carnage was even worse in the NASDAQ between March of 2000 and 2003. They lost 83%. Home prices dropped 33% in the global financial crisis. So there are times when you should just passively buy and hold stocks. This is not one of those times. For the first time in history, we have a triumvirate of asset bubbles. We have a massive stock bubble still. I think the S&P is down 15%. And even though it's down, it still represents one of the most expensive stock markets in history. And if you look at price to sales ratio, if you look at total market cap of equities to GDP, it's still in the thermosphere of valuations. You look at Shiller PE ratio. And then, of course, you have the housing bubble. You look at home price to income ratios, they've really never been higher. That's the best metric to judge a home price. It's not just that it went up. What's the home price to income ratio? It's just still through the roof. Historically, much higher than it was, even in 2005. And then you look at the cost of owning a home, which includes the insurance and taxes. Home price affordability is the lowest it's ever been. And then you have a credit bubble. What else would you expect? You would expect an equity bubble. You would expect a bond bubble. And you would expect a housing bubble when real interest rates were negative for most of the last 15 years. That has never before happened in history. Normally, money costs something. There's a cost to money. I'm not just talking about the nominal interest rate. I'm talking about the nominal interest rate minus inflation. That's usually positive. But for most of the last 15 years, it's been negative. It was the direct repression of interest rates by counterfeiting money, printing a tremendous amount of Fed credit, handing it to banks. Banks take that credit and they buy more of what the Federal Reserve is going to buy the next go around, which was mortgage-backed securities and bonds. That's what they bought. When you buy those bonds, they go up in price and the yield goes down. And when money becomes virtually free and profoundly negative in real terms, Wall Street goes amok. You know, like Blackstone will take that money, borrow it, and buy huge tracts of single-family homes. And that's one of the reasons why we have this immense housing bubble, which is in the process of faltering. My fear is we have a triumvirate of asset bubbles that exist concurrently for the first time in history. So that's a potential problem, and which makes that problem kinetic is when you have liquidity draining from the system. So you have, like I mentioned, the level of real interest rates profoundly positive. The reverse repo facility, which was once $2.3 trillion, is now practically almost zero. It's like $100 billion left in the reverse repo facility. The Treasury General account is being drained. It was once $800 billion. Now there's about $300 billion left. Bank lending standards are tightening. So liquidity is being drained. Taxes are going higher. Tariffs are taxes. According to some estimations, they're the largest tax increase since 1981. The border is being closed, thank God. But in short term, a reduced labor force, deportations and border closures on a second derivative basis means that there's less people coming into the labor force, which is 1/2 of GDP growth. If you look at the Department of Government Efficiency slashing government spending, by some estimates, government employment was 70% of all hiring under the Biden administration. If you look at direct government hiring and the ancillary effects of government suppliers, government contractors, that's ending. So if you have GDP shrinking, not according to Michael Pento, but according to the Atlanta Fed, Q1 GDP is supposed to be minus 2.4%. So you have government shrinking and liquidity drying up. You have the economy shrinking, the labor force shrinking, and the fuel behind these asset bubbles is cut off. So yeah, I'm concerned. Well, that's true that the underwriting standards are better this time around, but I don't take much solace in that because things like FHA secure loans, they're up 1,000% since the global financial crisis. You know, when you put 3.5% down and the default rates are surging there. But here's how I think about this. Year after year, especially after COVID, the amount of homes purchased by investors were anywhere between 20 and 25%. And one quarter it was as high as like 60%. Again, that's a derivative of money being virtually free. I mean, if a mortgage was 3%, and it was post-COVID, and home prices are going up 20% a year, and you could rent it out and get a nice, strong, positive cash flow, your money's costing you 3%, but your home price is going up 20% and you get that positive cash flow. Doesn't it make sense to like take out a bunch of loans and buy a lot of houses? Well, that idea isn't unique to a group of people. It was replete throughout this country, and especially on Wall Street. But that calculation has changed because now you're seeing the unemployment rate rise. I think it can go much higher than it is here. So that's going to cause a crimp in your cash flow because your renter might not pay you. And then let's just take it to the mom and pop who owns like 4 or 5 houses on the side, which I know many people who do. And they say, this is the calculation. Well, I'm up 100% on my 3 houses that I bought post-COVID. Now those home prices are starting to flatten out and roll over. And I'm paying an exorbitant fee on the taxes and the maintenance, and the insurance is killing me. So it's no longer a good investment. And my renter is not paying me anymore because him or her lost his job. So it's not like you go, oh, geez, do I really want to move? Do I want to change all my addresses? Do I want to call a moving van? Do I want to do, do I have to pack my whole house up? No, you just call the real estate broker and say, hey, dump these properties. It's so simple. And I think that process is just incipient at the moment. So yeah, the underwriting standards are better, but the quality of home ownership is terrible because it's not owner-occupied homes. It's not owner-occupied that I was a renter, now I own the home, but I had no business telling you I had a job when I don't, and I didn't put any money down. So now I'm going to sell my home. It's the calculation I just mentioned. I am an investor with multiple properties. And if I'm Blackstone, I have thousands of properties and I'm selling them. So yeah, could it be something very close to what we had in the global financial crisis? Yes, it can. And you add to that the bubble in credit and in the market. Yeah, there's every reason to believe it could be a loss of 33% that the Case-Shiller home price index dropped in the global financial crisis, down 33%. It starts with our central bank, and when they make money virtually free and negative in real terms, then you have Wall Street and shadow banks, which jump on board and do what their behavior says to do. And you have to ask yourself, why do we even have a central bank doing such a thing? Well, it starts with the government. It starts with the Treasury. So when the Treasury runs these massive deficits and runs up $36 trillion in national debt, which is now 720% of our revenue, you start to get fear in the bond market. And if the Fed wasn't expanding its balance sheet and buying and just being this deaf, dumb, and price-insensitive buyer of our debt with an unlimited balance sheet, then yields on the Treasury would be subject to the supply of savings in the country and globally. And if that was the case, then yields would be much, much higher. And that would render the nation insolvent. We already have $1 trillion in interest payments on our debt. If you look at mandatory spending, entitlement spending, defense spending, and interest, it's more than our revenue. And if you look at the total assets of the United States, minus our unfunded liabilities, we're insolvent. If you look at the Federal Reserve, you can say, well, they really have no choice because there has to be a buyer of last resort of our government debt. They don't do it directly because it's illegal just to participate in auctions directly. So they use the banking system as primary dealers as a conduit. Here's some bank credit, which is part of high-powered money. It's part of the base money supply. It's used to buy bonds, and then the banks go and buy government debt. So that's the truth. Now, you might not like to hear it. Maybe you do, but that's a fact. So first of all, if I'm correct, and home prices are going to drop in that neighborhood 25-30%, especially in the Sun Belt and North Carolina, Texas, and Florida, where everybody moved to, and all the banks are lending to, that's going to render a lot of banks insolvent, in my opinion. So there's going to be another banking bailout. And don't forget, banks are not only exposed to mortgage-backed securities, they also own a lot of treasury debt. Shadow banks own a lot of treasury debt. Collateralized loan obligations, which are leveraged loans. There's private credit in there too. So we have the most leveraged system ever. So I can't imagine if there's a problem in the debt markets and the credit markets and in real estate and in stocks, I can't imagine there's going to be a lot of banks out there healthy and making loans because they won't have any capital. So we're going to have another banking bailout, in my opinion. Let's just talk about Treasury. Treasury prices are a function of two things, especially on the long end of the yield curve. The short end of the yield curve is a function of whatever the Fed funds rate is, the money markets. So if you think about T-bills compete with the Fed funds rate. The Federal Reserve controls that rate. What they really don't control is the long end of the bond market. And that's mostly concerned with insolvency and inflation. Inflation has been above the Fed's, as I'm fond to say, 2% target for 4 years now. Now, why would our central bank, which is put in its charge to reach its 2% inflation target, it's really in 1913, it was stable prices, but stable prices have been redefined somehow to be 2%. But the way they calculate inflation has been above 2% for 4 years. By their own projections, inflation won't be back to 2% for a total of 6 years. And yet our Fed is in the process of a rate cutting cycle. Does that make any sense to anybody? Why would you be cutting rate? But this is a Federal Reserve that was buying mortgage-backed securities, was doing QE as late as the spring of 2022. So it's not just insolvency and inflation that the treasuries are concerned about. Let's look at China and these tariffs. Trump puts tariffs on, tariffs or taxes. Okay, that's exacerbating the inflation problem. But here's the problem when it comes to treasuries, not only insolvency or inflation. What tariffs are doing are going to dramatically lower the amount of global trade. Global trade is thus right now. China sends us hundreds of billions of dollars worth of goods. In exchange, they get dollars for those goods. So China gets dollars, we get cheap toys and electronics. And China has been in the habit of recycling that or just placing those dollars into our treasury market and into our equity market. If global trade were to shrink significantly, there would be a lot less of those dollars that need to be recycled into our bond market. That's one thing. The other thing is that China and Russia and any of our enemies have seen what happens when there's a conflagration between the United States and other countries. The United States can capriciously and arbitrarily just cut you off, just freeze your assets. So I think China is a seller of our debt, at least on the margin, and that's how prices move on the margin. And the evidence of that can be seen in the dollar and gold, because what I think China is doing now is they're stopping to buy our treasuries. There's much less demand for our treasuries if trade attenuates. And then what they're doing with those dollars that they're selling, they sell a treasury, treasuries denominated in dollars, they take those dollars and they're buying gold. So that would lead to a fall in the bond price, a rise in yields, a fall in the dollar, an increase in the gold price. And that's exactly the dynamic we're seeing. Same thing with Japan. Japan is the largest buyer and holder of U.S. debt. If you look at the Japanese 10-year bond note yield, in the fall of 2022, it was 22 basis points. It was under 1/4%. Today, it's like close to 1.5%. So now Japan is saying, well, wait a second. Even though they're our friends and though they're high on the list for tariffs because of the trade surplus they have the United States. So Japan is saying, guess what? What I'm going to do is I'm going to, instead buying your treasuries, I now have an alternative in my domestic market. So domestic Chinese investors now can buy Japanese government bonds instead of treasuries. So this is a picture of waning demand for U.S. debt. And you couple that with the massive debt and deficits and the inflation problems, and you have potential for spiking bond yields. That is not what usually happens in a recession. In a recession, part of the amelioration process bringing us out of a recession is when the Fed drops rates. They drop the Fed funds rate, which drags lower T-bills because they compete in the money markets. And then a recession brings buyers into the long end of the bond market for safety. That's the normal dynamic. And those lower borrowing costs they act as a salve to boost asset prices after a while. Not right away, but they boost the economy and asset prices after a while. This time around, you might not see anything like that. You could potentially see much higher interest rates because of the dynamic I just explained, which would cut off that ballast of falling interest rates and from lower borrowing costs. That's the real danger.